All right, let's get practicing in QuickBooks Online. Grab the link below in the description so that you can follow along. All right, here we are in the QBO gym. And the QBO gym is a place where we have numerous exercises that simulate real life scenarios that you may encounter as a bookkeeper. Every single month, we come out with new exercises and we break it down for you into 4 different sections. So today we are going to be working in the October cooldown section. At the top here is a little animated video to tell you what's going on in Craig's world that month. He is our fictitious business owner. Further down is an interactive quiz to test your knowledge as it relates to the video up above. And then further down are the exercises within this section. So today we are going to finish up the cooldown section by practice running Craig's reports. You will need to be in the sample company. If you are not sure how to get into the sample company or get your own free QBOA account, go ahead and click on the link below in the description. So after you have reconciled your bank statements, it's time to run reports. You'll create a P&L or profit and loss and a balance sheet for Craig. Now that business has been really picking up, Craig is starting to work on some longer term business goals, but he feels like there should be more money in the bank than there is. Before we can take a deep dive into Craig's cash flow, we need to talk to him about the balance sheet. So let's prepare for the meeting with Craig. The first thing we need to do is run that balance sheet. So on the left-hand nav bar, we're going to click on Reports and then select Balance Sheet. So here I am in the sample company. This is the dashboard. Over here on the left-hand nav bar, here is Reports. Click on that. And when you get the Report Center open for you, under this Favorites, you will see Balance Sheet. Go ahead and click on that, and you will see the balance sheet run for you. Now, the balance sheet lists the totals of each in each account as of the date of the report. So, in the header of the report builder, QBO shows a report period. And this can be confusing because the balance sheet always represents one day, the last day of the period. So, why is it showing a range? Well, the beginning date is the date of the first transaction shown when looking at the details of each account. So, let's see how this works. Under the report period, we're going to adjust it so it says this month, and then we're going to run the report. So let's go ahead and scroll back up. Here is this report period right here. Right now it's showing as year to date. So go ahead and click on the arrow and select this month. And then you want to go ahead and click on the white Run Report button. And now it has been adjusted. But you will notice, if you didn't before, that the total values here did not change. They are still showing today's values. So we're going to go look at the checking account. On the checking account, you're going to click on 1201. As a note here, the amount may be different if you are in the same session of the sample company that you used for the previous exercises in the cool down section. That's okay. We're not as worried about the numbers in this particular exercise. So if it's different, that's okay. Just go ahead and click on the one for the checking account. So checking is an asset. It's under the bank accounts. Here it is. Go ahead and click on the number right there. And you will see this transaction drill down report appear. The beginning balance is the balance from the first day of the period. So we're going to go back to the balance sheet in a minute, but this report shows the makeup of all the transactions that make up the balance. So here is that beginning balance, which is right here. And then within the month, the ending balance is over here. Okay. So we're going to click on back. It's a little blue link over here on the top left. Click on that so we can get back to the balance sheet. Now that we understand what we're looking at, let's take a deeper dive into each of those accounts so you really understand what is on the balance sheet and speak intelligently about it with Craig. So the bank account, we're going to start with the assets. The bank account is an asset because this shows the total amount of cash in the checking and savings accounts. Since you just reconciled these accounts, they should be fairly accurate, but money changes hands all the time, so it might not be the same as what you would see if you opened up your bank mobile app and looked at that balance. So here under assets, you see here are your bank accounts. The next area is the accounts receivable. This shows the total amount of money that Craig's customers currently owe him, or invoices that have been sent but they have not been paid yet. This would be a really good topic of conversation with Craig. You can always run an accounts receivable aging summary and discuss how long it's taking people to pay their invoices, and then perhaps devise a strategy for paying at the time of service or instituting deposits or late fees. So accounts receivable is the next area down here. Then we have inventory asset, and this is the total cost of the current inventory items in stock. Note that it's not the resale value. That is, it's not how much Craig could sell it for, but rather how much he could have paid for. So inventory is right down here. It's called an other current assets. And then we're going to look at undeposited funds. These are where the checks and cash are quote unquote held until they are deposited into the bank. It's a good idea to encourage Craig to deposit his payments right away so you don't run the risk of losing them or being unable to cash the checks. Then we have something a little bit further down that says truck. This shows the current book value of the truck. Book as in like bookkeeping, QBO book, that kind of book value of the truck. As Craig uses his truck, the value should depreciate or decrease. In accounting terms, depreciation does not affect the resale value of the truck. In other words, it does not mean that the truck is worth any less. It simply reduces the value of the truck on the books to reflect the use and wear and tear of the truck over time. That wear and tear is recorded as a journal entry and becomes an expense to the business that is reflected on the profit and loss statement. A good bookkeeper will stay on top of this and ask for a depreciation schedule from Craig's accountant. Ideally, it is reflected monthly. So let's see where that is. Here you see under fixed assets, this truck that it's showing here. So now let's move on to liabilities. The first thing here is the accounts payable, and this is the total of all the bills that Craig has yet to pay. Staying on top of the bills and making sure Craig does not become delinquent is an important part of the cash flow discussion. Late payments can incur fees and affect Craig's credit rating. So here we're moving down into the liabilities and equity section. Here are all of the liabilities right here. Here is that accounts payable or AP showing first. And then we're going to see the MasterCard. Craig seems to have a fairly low credit card bill, so this is just another one that we want to keep an eye on. And the credit card is right here, that MasterCard. And remember, a liability is something that is owed to something or someone else. So that is why that MasterCard is down there. So then we have next the Arizona Department of Revenue payable and the Board of Equalization payable, which are both monies due to the sales tax agencies, as we learned in the strength training section. It's under other current liabilities. There are the two right there. Then we have loan payable in that same section. And what exactly did Craig take a loan out for? When does he have to pay it back? Where did the money go? Since it is listed as a current liability, it should be paid back within 1 year. Does Craig have a plan for this? This is a really important discussion and something that you as his bookkeeper really need to understand. That loan payable. Other current liabilities, there is that loan payable. If it is more than a year that it's going to take to pay back, it should go into this long-term liabilities, which we see something under there that says notes payable. And it seems that Craig had borrowed $25,000 from someone. So where did this money go? If he took out a loan for the business, the money should have been deposited somewhere. And if it is a line of credit, it is not considered a liability until it is actually used. So you will need to, again, address this with Craig. And now the biggest red flag that we have here is our opening balance equity account. So if you remember, we started off, we did all of the assets, we looked in that section, then we went through the liabilities, and now we've moved on to equity, which doesn't have a lot under it, but it is quite important. That opening equity balance, it reflects the amount of money, asset value that the business started with. In an ideal situation, this would be zero as all money that came in came from somewhere, whether it was the owner's personal contribution, an investor, or a loan of some kind. If that is what has happened, then that's how it needs to be categorized, not as an opening balance equity. Really, the open balance equity account really should only have a balance if the prior starting from zero record, or I'm sorry, if the prior starting from zero records are in another system, and when they started QBO, they didn't take the time to bring them over. This would make sense if the business had been in business for a really long time or had a huge volume of transactions. Opening balance equity should never be a negative number because that would indicate that the business started as less than zero. If you took out a loan, which feels like it's starting less than zero, the cash received from that loan should be reflected somewhere and and then balance things out. So you will need to spend some time cleaning this up, cleaning up how some of the items are recorded. But we're not going to do it in this exercise. Just know what that account is for and why it's really important that it really should be at zero. So let's go ahead and move on to running the profit and loss, or P&L, so that we can get it off to Craig. To do this, we need to go back to the report list. So we're going to scroll back up to the top. Here is the blue link that says back to report list. Click on that. And then we are going to click on profit and loss under the favorites section. And it has been run for us. So we are going to leave it as is. All you need to do is choose how you want to send the report to Craig. If you are meeting up with him to go over the details of the balance sheet, you may want to print it out and bring that with you as well. So you have lots of options. You can email, print it, or download it as a PDF or an Excel document. But there you go. That is a really deep dive into the balance sheet and how you would run those reports for your clients. And if you have any questions or want to know more about the QBO Gym, just go ahead and click on the link below in the description. We have finished the October issue of the QBO Gym. Congratulations, you did a great job. Keep on practicing and look out for our November issue coming out real soon. And I will see you then.